We're going to have a bit longer than usual Monday morning analysis today. We're going to cover the upcoming week for Tesla, which of course will be a big week for the market. And we'll also do a brief review of Cathie Wood's monthly analysis that she put out on Friday night. For those who appreciate her thinking, well, that will be last in our list of things to accomplish today. All right, so let's start with Tesla. Well, just 1 minute. First of all, you may not know who I am. I'm Randy Kirk. You might want to like this like it if you like this kind of content, if you like to be updated on these financial situations. And then, of course, subscribe. And this would be a great time to hit the button to be notified of future items, because we have a long list of great stuff, interviews with Warren Redlich, interviews with Brian Wang, and also interviews with Herbert coming up this week. So anyway, it's going to be a big week. You might want to be notified. Finally, join my Patreon. It's only $5 a month. And some of these things that I do, some of these videos will come up early for you, and we'll have other benefits as well. All right, let's get into it. Let's start with Tesla. Clearly, the earnings report and the call after will be the big story of the week. And I will have a pregame show on Wednesday morning and a postgame show on Wednesday afternoon. However, the Starship launch that takes place on Monday maybe, if it takes place on Monday or sometime this week, might be almost as big a news as the earnings report, because anything that Elon does that calls attention to his abilities with regard to running companies and doing science and creating products, anything that calls attention to his successes, assuming it's also successful, which there's always a greater than zero chance that it won't be, this calls attention to Tesla as well. So this is advertising for Tesla. For those of you who don't think there's any advertising for Tesla, this counts. There'll probably be some Tesla automobiles too, taking people to and from. They'll be parading around in the view of the cameras during the takeoff. So this is a big deal this week. And then in addition to that, for the company that does no advertising, Elon will be on the Tucker Carlson show on Fox Monday and Tuesday night. Now, from what I can tell, this is mostly going to be dealing with Twitter and AI and the new AI company that Elon has opened, and kind of all of these kinds of things around free speech and whatnot, which would be what you might expect on a conservative radio program. But let's face it, conservatives are a little late to the party when it comes to EVs. They are buying them. I'm a conservative, and very many of my conservative friends have EVs, but I'm also in California. In the flyover states, the conservatives are not buying EVs anywhere close to the same percentage. And so getting to speak to them and getting Elon introduced to them and showing that he's a great guy might go a long way to people starting to change their mind about EVs in those regions. That's the biggest market in the United States that is yet to be where Tesla has failed so far to really make an impact. Okay. And of course, with the Cybertruck coming out, that'll even be more important, and maybe that'll help. Okay. I think, so yeah, I've covered all that. Let's go on to the next one. Earnings. Okay, that's the biggie for the week. The earnings report. Here's my estimations. I'm still saying $1.08. The street is at 86 cents. Some people are as low as 64. Anything over $1 should be a win. Will it move the market? Maybe over $1 you'll see some increase, but quite frankly, it's what's said in the call that'll probably have more of an impact than what happens in the earnings report itself. But it couldn't hurt to be in the $1+ range. And even if it beats the 86 cents, that'll be good. And as I've said in a couple of my videos recently, Tesla right now has to prove it every single quarter. That's how things are in this kind of market. It's not a go-go market. It's not a risk-on market. Tesla has to prove themselves as being stable, solid, growing like crazy, adding free cash flow, et cetera, in order for the stock market to really appreciate them the way they should. Okay, number two, I'm hoping for auto margins of 22% or more. Anything above 20 will be a beat. I'm thinking 22. That could be a really good beat. I don't think it'll be anywhere near 25. But anyway, that's kind of the range, so you can watch for that. Yes, a 22 probably would also potentially move the market. Average selling price, I'm at 44,000. I'm a little low. Some people that pay way more attention to this than I do are at $47. Other people are saying it might drop as low as 40 because they're taking 20% off of 50. And that's kind of not a very good way to do it. So there's too many moving things. I did an entire video on that. You can go back and take a look. I'm at 44. I feel safe at 44, but it might be higher and it might be lower, but anything above 40 should be a win. I think it'll have to be over 44 to have a significant impact or any kind of impact on the stock price. And if it's over 47, that could really move the market. All right. So then we go on to the next one. Number 4 is the gross profit on energy. Anything over $1 billion is a win. I'm thinking it might come in at 1.5. If energy comes in over 1.5, I think this will be the beginning of the signal the street needs to see to understand that energy storage is huge and that it's going to be bigger and bigger and bigger and going to dramatically impact earnings downstream. Right now we have with just Lathrop and the Shanghai plant that's going to be open, let's say in roughly 9 or 10 months. Those two facilities, when fully ramped, will make more money per year than Tesla made all of last year, just those two plants. So I don't know, is that important? Seems important to me. All right, so anything over 1.5 billion in profit for the energy sector would be a big win. And then 5, operating margins over 15% will be a win. So we've been told by Tesla to watch the operating margins. So that's the total of all enterprises, subtracting all overhead, you get the operating margin. If the operating margin is over 1.5, I think that should be considered a win. If it's back up in the 1.7, 1.8, that would be a massive win. I think it's going to continue to climb through the rest of this year as all kinds of things happen that are going to be driving down costs, and all things are going to be happening that are going to be driving up revenues. And the revenues that are going to be driving up, like the Model Y, are higher dollar revenues and higher margin products than the rest of the products in the mix, including energy, which is a higher margin product. So I think that the operating margins, that's why they said to watch that. They could be climbing up 1.8, 1.9, who knows, maybe hitting 20%. That should be 18%, 19%, and 20%, later this year. All right. So those are the things I'm going to be looking at when the report comes out. These are the 5 things I'm going to be looking at that I'm going to be caring about. Sure, I want to know what free cash flow was. Yes, I want to see, how much money they're investing. There's a whole bunch of little other things I want to know. Those are the 5 biggies. Then, of course, we get into the guidance. We get into the call. It's kind of fun. If you watch the after hours stock, you have that thing on while you're listening to the earnings call. It's kind of fun to watch it go up and down as different people make different points, especially when Elon speaks. Anyway, the guidance will be interesting and could move the stock. That's the most likely thing to move it, either up or down. Number 1, there'll be no guidance above, I don't believe there'll be any guidance above the 1.8 to 2 million cars manufactured and shipped this year. I think it's 2.21 as a minimum. I don't see how they can do fewer than that, but I don't think there'll be any change in the guidance of 1.8 to 2 million range and the continued statement of 50% year over year growth on average, not every single year. Number 2, I think we can hope for some additional hints on cyber and semi-truck, Cybertruck and semi-truck, but probably not. There might be a comment. Somebody's going to ask questions about both, and I'm not sure we'll get anything meaningful in terms of answers, but anybody can hope. I'm a little bit of hopium here. Okay. All right. Number 3, we could also hope for some margin guidance on Lathrop on the energy storage batteries, the megapacks. I also think that's unlikely, but I'm sure the question will be asked by somebody, and it'd be great if we could get some idea. Is it really 50%? Is it more like 40%? Is it much less than 40%? This would be huge information to get out of the earnings call. Next, markets. All right. So the news, the stuff that breaks this week, of course, is broken down into 3 things. The things that are reported, the government reports, S&P reports, and things that we see each week. There's a different set of reports. Then you have the Fed, what they say and don't say, and any moves they make. And then 3, you have the different companies that are going to be reporting their earnings. Well, let's start with the thing that's going to happen that's most likely going to move the market. So you have Fed speaking almost every single day. one or another of the Fed presidents has a speech almost every single day. Will they reveal anything? You just never know. And then all of a sudden they can say something like, yeah, I think we're really headed to a recession in the fourth quarter. And boom, the stock market goes down. Or somebody else could say, oh yeah, I think the interest rates have to keep going up because inflation's out of control. Those are both things that were said last week. Okay, so confirmation of those, walking those back, having differences of opinion, might help the market. Continued statements about the market, the overall business climate continuing to contract, going into recession, hard landing, those kind of things are going to not be good for the market. And anything that might be said that we'd be walking back some of that stuff and saying, no, it might be time to pause, or this will be the last 25 basis point increase. Any kinds of things like that might be helpful. And then there's the whole question of banks. So let's see here. I'm going to put out a contrarian. Okay, before I do that, let me just say, I think the market is going to trend sideways for a very long time, maybe for 2 or 3 months. I don't see it breaking out into a new bull. I don't see it crashing into a bear. I think there's so much confusion and so much flight to safety. Cathie Wood agrees with me. We'll be talking about her in a minute. She says she's seeing flight to safety everywhere. That would indicate why the 10-year bond, the people are buying that 10-year bond. The rates are so high. People are buying the 2-year and the 2-month. Huge flights to safety. She's going to claim that the flight to cyber currencies is also a flight to safety. I'm not buying into that one yet. All right, let's move on. But there's a lot of confusion, a lot of inability to figure out the direction of the overall economy, the direction of interest rates, the direction of inflation. And while that's going on, I don't see any breakouts in either direction. So it could be a month or 2 months or 3 months before we see any beginning trends. Now, Elon Musk says he thinks there's going to be a recession in the second half of this year, and he thinks that it'll be over and we'll be back into good times in 2024. Take that as just one more opinion, a pretty important opinion. He sees way more data than you and I do, but that's what he's betting on. All right. Now I'm going to suggest a contrarian point of view on interest rates. I've been through the interest rate crazies of the 70s and 80s. If you were alive during that time, if you were in business as I was during the 70s and 80s, well, you know what? You pay what you have to. If you're buying a house when interest rates are 10 and 11 and 12%, and you need to buy a house, you pay what you have to. So people will take out loans, people will buy cars, they will buy houses, and they will buy equipment, and they will borrow money for operating capital for their businesses, and they'll pay what they have to. They'll try their best to get the lowest rate. They'll try their best not to borrow. They'll try their best to extend their accounts payable and collect their accounts receivable faster. They'll do all kinds of things to make sure that they don't have to borrow. But if they have to borrow, and they will borrow. However, the other thing is true too, is when you have these higher interest rates, some companies are not going to be able to afford it, and they will not be able to pass along the higher costs to their customers. If they can't, then they're going to fail, or they're going to start to fail. And then they'll slow up the economy. They'll sell less. People will, their customers, their suppliers will not be able to have as much business with them. So yes, all of that happens, and that is what's happening. I disagree with Cathie Wood, who suggests that the interest rate increases have been so dramatic on a percentage basis, going from 0.5% up to 5% in such a short period of time. That's a 20 times multiple or something. I don't think that's what matters. What matters is the actual effective interest rate and whether you can afford it in your business. And going from paying, say, 5% for prime to paying 10% for prime, yeah, that's a doubling, and it is going to affect your ability. You're going to have to find ways to either suck it up or pass on those costs to your customers. But I don't think that is dramatic enough to cause a big problem in the overall economy. For banks and other investors, yes. And that's why we saw Silicon Valley Bank fail, is because they had made a long-term investment in these 10-year bonds that were 1.7% interest rate, which might have seemed smart at the time, but turned out to be dumb. And there should have been plenty of signals for them to get out of those bonds way before they did. And so they ended up upside down on their balance sheet with regard to the value of those bonds, even though it had nothing to do with their cash flow. But then when cash started coming out of the bank, when deposits started flowing out of their bank, they needed cash in order to replace those deposits, and they had to sell some of these depleted assets at fire sale prices. And that, of course, is what bankrupted them. Is there a bunch more of that going to take place? I've seen arguments on both sides. Some people say there's more of that going to happen. Some people say there isn't, that everything's safe now. I'd say it's split about 60-40 in favor of those who are saying, no, it's all taken care of. Cathie was much more concerned, anxious about it. And she was pretty dour the entire call, actually. So we'll see what happens. But I think that the bonds have been in the same position practically for a year now with this inversion at it's pretty much the same level. There was times when it got a little higher now, but it's still hugely. You got the 10-year with the 2-year inverted by 50 basis points. You've got the 10-year with the 2-month inverted by 150 basis points. Those are really significant and they need to come down. Is it going to kill the economy? Well, that's a whole nother issue. So that issue is money supply. So the money supply is back down to normal in terms of increasing, decreasing, but the amount of money supply coming in has been going down, 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 down to get back to normal. So if you look back 2 or 3 years, around 10 is the number. Now it's getting back down to the 10 level. But if it continues lower than that, that could start to dry up capital in the system. If that dries up, and then you also don't have the velocity because there's not as many transactions taking place, so the velocity starts to slow up. And then on top of that, the regional banks maybe start pulling back in. We talked about this, I think, last Wednesday or last Friday in the financial videos that I did. You know, I do one on Wednesday. The one on Wednesday is a midweek report. The one on Friday is the good news end of the week report. And then this one that I do Sunday night that it's called Monday morning, that talks about next week. These 3 reports. So I talked about it last week that there's no question that the regional banks might be pulling back on some of their riskier loans. That could really start the problem to happen. That's where I agree with Cathie. Okay, let's go on. Oil seems stuck at 80-ish. We can live with 80-ish. Rather go back to 70-ish. Don't want it to go much higher. Watch oil. I just mentioned that the 10 years continue to be stuck around 3.5. Once again, I think we can live with that. The 2-year stuck at 4 and the 3-year stuck at 5. I mean, the 2-month stuck at 5. I think we can live with all of those. I don't expect to see much change. I just don't expect to see much change. So, but again, if you see a massive change, if you see the 10-year start to head towards 5, that would be something to pay attention to. Okay, let's see the reports that are coming out this week. I think nothing in terms of reporting will be that shocking. Most of the reports that come out this week have to do with housing. Housing itself is doing better than expected. The reports this week may continue to say that. We are going into the spring buying market. Spring and summer is when people that want to buy a home typically are out looking, and people that want to sell a home typically say it is the best time to put it on the market because you got lots of customers. The problem this year is nobody's putting their house on the market because they don't think they can sell them in this interest rate environment. And the other side of the coin is people that want to move, need to move, and want to buy a house, want to sell their house and buy another one. There just isn't any inventory. So the pricing, I think pricing will be sideways, maybe even slightly up on existing dwellings. I think people that are building houses and that will have them available for sale will be able to sell them at a reasonable price. And I think that people have gotten used to the 6% interest rate. And I've also noticed that what's happening now is some sellers are buying down the interest rate to 5.5%, 5%. Mentioned that in the Friday night show if you want to go back and take a look. Okay, so I don't see any surprises. Doubt there'll be any surprises on that. Let's see, we have a home builders confidence index is Monday. Tuesday is housing starts and building permits. Wednesday is existing home sales. So those are bunch of housing stuff. If you're interested in the housing stuff, it is a lagging indicator, but this time new housing or purchasing residential housing is being thrown off again by this entire COVID and everything else that's happened because there just isn't any inventory and nobody that's sitting there with a 2 to 3% loan is inclined to sell their house. All right. On the other side of the coin, Redfin says just today, in an article today, that rents decreased last month on a year-over-year basis. This has not happened in 3 years. Mostly in Austin. I think they mentioned one other market, I forget, I think it was Chicago. Chicago and Austin in particular were down year over year, but other markets are showing year over year decreases. I've been talking about this for at least 2.5 months, maybe 3 months, that there was a lot of multifamily dwellings being built, that it looked like this was going to be enough to make the market saturated and possibly oversaturated. That is what Redfin is reporting right now, is that we're now seeing that rents are coming down because there's plenty of available. Now, every region is different. Your neighborhood might be going up, but real estate is definitely a region by region business. As the old saying was, location, location, location in the real estate business. So we got that going on. On the commercial side, there is also another dance taking place on commercial real estate, where the regional banks are typically the ones that are providing the lending for the regional kinds of the commercial real estate, and they're pulling back on lending, and they're having to raise their rates on lending, which is hurting commercial builders. And there's plenty of office space, which is hurting the values of office buildings. There's never going to be enough. Well, okay, that's not true. They're still building distribution centers like crazy, and distribution centers and factories and things like that. There's a shortage. Maybe does that mean some office buildings have to be collapsed in order to make room for more distribution or light industrial? I don't know. We'll see if there's some switching around in the marketplace. I'm sorry, I'm starting to lose my voice here. All right. Other reporting this week, the manufacturing index on Monday. This is the one where they polled the manufacturers to get their opinion of how things are looking going forward. I would expect this one not to be that great, but I don't think it's going to be that bad either. So you might want to check that one out. On Wednesday, we have jobless claims. The Fed would like to see that go up. I don't see how it's going to go up. We still have over 7 positions available for every one person looking. I don't see how it's going to go up, but we'll see. Maybe it goes up a little, but I don't see it going up. We have on Wednesday also the Fed manufacturing survey, a separate survey of manufacturing activity. I'm sorry, the one on Monday, was not where they asked the manufacturers how things are going. They actually look at manufacturing activity. The one on Wednesday, the Fed manufacturing survey, is where they do ask the manufacturers how things are going. And then on Wednesday, also the leading indicators. Now, this one might be one to watch. The financial reporting people have not been talking about leading indicators very much recently, I think because there's so much confusion. And so I can't remember the last time I saw anybody report. I saw a headline, oh, the leading indicators say. And yet in other times, other periods in history, the leading indicators was what everybody was paying attention to. Anyway, we'll see what happens on Wednesday, see if that's of any value. And then on Friday, we get the Flash Services and the Flash Manufacturers Purchasing Managers Index. I think this is very valuable. The actual indexes, which come out, I think 2 weeks later, or maybe it's next week. These are flash. These are like, okay, this is what we think. We got enough information to give you some idea. So take a look at the flash. I'm thinking both of these are neutral to trending down. Okay, and it won't change the market. All right. So then we have reporting. We have the reporting this week. Tesla is not the only mega cap stock, mega cap tech stock. To report this week, lots of other reporting this week. Again, yes, the market will move if somebody misses on their top side or misses on the bottom line. Yes, they will move depending on, some of the things that are happening individually with these companies. But the key is going to be looking at the expectations. You want to see what the guidance is from these companies. Are they giving neutral guidance? Are they giving good guidance? This is what's going to move the market. Again, it may not move it a lot, and maybe you're not in and out all the time, but if you're interested in the direction of the economy over the next 6 months, this is going to be where you're probably going to get your best information. All right. Commodities, PPI are showing they're not likely to see inflation going back up. The commodities are still headed either down or neutral, except for gold. Gold, of course, is a flight to safety. But all the rest of the commodity, and I mentioned oil went up a little bit, but now it's been flat. So I don't know. I don't see commodities going back up, but you never can tell, because that's the nature of this wacky market right now, is that maybe there'll start to be some shortages because people have cut back too much. We'll see. Okay, let's see. More things about Cathie. No, I think I covered everything about Cathie. Yes, a flight to safety. That was the biggest thing. And her report was, the reason I didn't do a separate report on it was because basically there wasn't much other than those two things: her continuing concern about the money supply, or considering her concerns about going into recession. And that's pretty much what she wanted to talk about. Again, as I've mentioned last 2 or 3 times, this time of year in this kind of market, what you want to watch is home sales and prices to see what's happening with that seasonal business that's coming up. Travel, another seasonal business. Right now, travel looks strong and housing looks strong. Repairs and remodels, and you can check Home Depot's stock price for that. And I think Home Depot, it's either this week or next week, I think they report. So then you could get some information from their reporting and from their from what they're telling us about the future months going out. So I think I've covered it all. I told you it was going to be a little bit long, but that is the conditions on the ground right now. Again, be sure to watch. Tomorrow I've got an interview with, in the morning, I think it's with Brian Wang, and in the afternoon, it might be with Herbert. And then another one with Warren Redlich on Tuesday, and maybe another one with Brian. Anyway, one after another, great interviews coming up this week that you will not want to miss. So hit the subscribe button, hit the notify button, and then join my Patreon. Okay, it's been great talking to you.